Welcome to Multifamily Rockstars. If you are new to apartment investing or already experienced, you will enjoy this show. You will hear from the leading experts in multifamily real estate so that you can be a better owner, operator, and investor. Real people, real stories, life-changing. And now, your host, Ryan Christopher Nunes.
Well, welcome to Multifamily Rockstars. Today's guest is Charlie Young. Charlie is one of the founding partners of Madera Residential. Madera is an investment company based in Lubbock, Texas, that acquires assets in DFW and Houston. Madera owns 48 properties worth $1.3 billion and manages roughly 15,000 units. Charlie focuses his time on acquisitions and capital raising. Charlie, welcome to the show.
Thank you. Thank you for having me.
Awesome.
Looking forward to the chat.
Great. Well, thanks for making the time for us. Well, let's jump right in. Walk us through your background. Tell the listeners a little bit about yourself.
Okay. So when I got out of college, I went to work for Hoffman Roche Pharmaceuticals. And I was a sales rep out in Lubbock. And that gave me the opportunity to meet two individuals, Steve Hurt and Paul Stell. And Steve was already in the business, and I'm in the pharmaceutical business, and Paul's getting out of, he's still in school. And we ended up buying our first deal in 91. And it was a little 24 unit deal that was coming out of the RTC days in Andrews, Texas. And then we bought another 24 units across the parking lot from it. We tried to get the other 24 units. They were all in 3 different S&Ls. That was back in the days. That was way before a lot of the folks that are going to watch this
Sure.
Of the S&L debacle. And so I'm still running along working for Hoffman LaRoche. And I go off to New Jersey for a year to be a sales trainer. And then I go to Florida to be a district sales manager. And so Paul and Steve thought I had all of this great management experience and asked me to come back and partner with them and start a management company. So I did that. And so my beginnings do come out of the management side of multifamily. And so for the first year, I knew nothing. I lost them an awful lot of money. And we got through that year, and from there on, away we go. And so, that was 96. So you can say I went pro in the business in 96. We were buying just a few deals, not a whole lot. And I was a minority partner for that. And then, in 98, we said, hey, let's start managing for other people. So we got our first management deal in December of 98. And that's really where I cut my teeth, was on management for a number of other people in West Texas. That spread into Houston, spread to Dallas. And so that became the basis for me understanding submarkets in those particular areas. And that was the beginning. So I did come up on the management side. At one point, Steve decided to retire. Paul went on for a while into some residential stuff. And so that opened the door for me and 2 of the other guys to come together and start Madera in 2008. And at that point in time, we had started winding down our fee management business. Lesson in that, we thought we could help everybody. And you come to learn there are certain people that don't have the right motives or did not buy the asset right, and there's nothing you can do. And so either they fired us or we fired them. And about 2008, we were probably down to 2,500 units that we owned and managed from, I don't know, somewhere north of 6,000 units.
Wow.
And I had a property in Clear Lake that was a big property, 520 units that we were managing for another group. And it was a value add, big value add, 10,000 a unit at the time. 10,000 a unit was a lot. Complete interior upgrades. It was 25% occupied.
Wow.
We did everything, and they cleaned the clock on it. We made pretty much nothing, and I think that was the deciding point that, you know what, we need to go figure out how to do this for ourselves. And so in '08, we bought our first deal.
Okay. Wow. That's interesting story. And so one thing that you touched upon, just giving your experience, you said RTC. So maybe for some of the listeners, you can just expand upon what that is.
So that was the Resolution Trust Organization, and that was the government vehicle for disposing of assets coming out of the late '80s when we had an economic collapse. And so, at that point in time, there were tax incentives the incentive was to just buy any asset and write it off and it not be a property that can make money. And that worked for everybody. And then the government changed that. And then when things don't work and there's no tax incentive, everything collapsed. And so there was an opportunity to pick up an awful lot of properties at that time through what was called the Resolution Trust Corporation.
Great. Thank you so much. And so, as you kind of gave us the background, I guess, as Madera, pre-Madera, if you will. So, fast forward today, what differentiates Madera from your competitors?
That's a good question. And I don't know that I have a really solid answer for you. I've got really good friends in the business that are owner operators like us. We are syndicators. Most of those guys have now left being syndicators. Some are into development. One's started out same place we are, and he's into development now. Another one has moved on into newer assets. And so whether it's Madera or anybody else, everybody's got a different way to view how they're going to run their business based on their skill set. So I think ours has been more set up based on, I've got 3 other partners. Dave Marcinkowski oversees management and technology. Gary Hall and I've been together back in the Hurt and Sell days since 1997. And Gary oversees all of our construction projects. And Dave and I got together in '04. And when he came to Lubbock, and Alton Smith started up with us in '09 after the crash, the Great Recession. And Alton's kind of like our lead partner, CFO type. He's a CPA, and so he takes care of all the leadership on that, so to speak. And I'm not sure where I was going with that story. Where were we going, Ryan?
Well, we were talking about what differentiates you, and,
okay.
you were talking about kind of the org structure and how you're.
So you take, a lot of people would sit there and go, okay, man, that's a lot of chiefs, and it just works for us. Everybody stays in their own lane. And I don't do anything with accounting. I do very little with operations. I do very little on the construction side. Mine is acquisitions, asset management, equity, kind of structure in the deal is the lane that I fit in. And that's, we'll talk about a bunch of things today, but that's my unique ability. And so it's just the way we kind of got structured. So it's worked for us.
No, that's great. So you had mentioned acquisition. So let's pivot to that. So have you been actively buying during COVID?
Mm-hmm. Yeah, we bought. We will have closed 5 deals this year, starting in April, in the middle of COVID.
Wow.
We bought a 256 unit '80s vintage deal in, I think an '84 vintage in North Richland Hills. Then we probably, I think it was June, we bought 148 units in Garland. That was probably '82 vintage. Both of those were value add. Then everybody's sitting around trying to figure out what the next evolution is going to be. We're all looking, trying to figure out where the deal is. One pops up in Houston, be a little outside of what we would normally do. It was a very, very distressed 2017 Core Plus asset that a lender had to get out of at a really big fire sale. So we bought that in September. That was 354 units. And then following up on that, in October, we closed a 322 unit 2018 vintage in Dallas that we got a little bit of a discount on, in a great location. And last week, we closed 82 units in Richardson. That's a 2016 vintage. So we were all over the map for pretty much everything that you could think of. And we've got right at about 1,500 units, I think, queued up for January through March of 2021.
Wow. So, it's pretty interesting. I appreciate the color on the vintages and the unit sizes. And so, I guess one thing that's similar is it's kind of DFW or Houston. Some of the things that are different is you kind of had almost a 40-year span in vintage. So just walk us through, the investment criteria and, the types of assets that you're looking for and interested in.
Okay. So I always tell people, we can't manufacture deals. You can't, it's just, when one shows up, okay. And I also say there has to be a story with pretty much every deal. Madera's not buying assets that they're just totally stabilized. There's nothing to be done. There's no value add or no opportunistic play. And so there's got to be a story on it. And so, for today, I would tell you that for our limited partners, I think I can find properties that over 5 years will have a 14 to a 15 IRR and, an average cash on cash of 7%. And that pretty much equates to about a 1.85 to a 1.9 multiple. And so that's what I'm looking for. That's what I'm looking for, and it can come in any variety that span you just saw.
Sure.
And so as a deal comes up, so I think one question that we're going to have is, how do you filter through what you're looking at? So absolutely. In 2020, we look at pretty much everything in some form. If it's on the market, we've got a team in Frisco that will take that down, look at it, and we'll take that information, whether we're going to use it or not. And so we drew down information on north of 200 units in 2020. We did a deep dive, full underwriting on, right now it would be north of 110 properties. And we put offers on, I want to say 20 deals. And so we closed roughly 1,200 units in 5 properties. And we got, call it 3 assets. They're big assets that are coming up at the first of the year. That would be a part of that underwriting. And so it's important for us to look across the market from C assets all the way up to core assets, to be able to understand the dynamic of what's happening in the market. And it gives me the confidence to know that I'm getting, when I finally say, yes, we're pulling the trigger, I feel absolutely confident in the basis of what we're buying.
And so, I appreciated that, it's not necessarily, it's more about if a deal pencils, then you're interested in it. The vintage size, it's kind of, it can be anything effectively.
Yeah. So like, and one of the beauties for us is because we have this limited partner base, we have the latitude to do whatever makes sense. So there are some companies that they will put together a fund, and the fund says we have to do X, Y, Z, and that's all that we can invest in. And from the example of the properties I gave you, we went from 80s to 2018 vintage in 2020 because those were deals. And so that gives us the opportunity to be opportunistic. I think probably a key word for Madera is just being opportunistic.
Okay.
And so I think that's probably the best way to couch it.
And across those 5 deals and across other assets that you've owned, have there been any themes in terms of things that get you excited in terms of, hey, that sounds interesting, that looks like it would fit, the type of asset that we like?
Let me think how to answer that question. It's okay. So you could say, are there any deal killers? And so I'll give you an example of one that would typically be a deal killer. I would say it's very, very hard for us to find a deal that's got debt on it that you're going to assume and make that work. Well, the 82 unit deal that we did last week is has debt on it.
Interesting.
But it had such opportunity that I go, it's the first one we've done. And
That's been a loan assumption.
yeah, it's been a loan assumption. And we had to scratch our heads a little bit in going through that process. We've done an awful lot of agency work, but an assumption's a little bit of a different animal. And so I think my message out of that is be very careful about being regimented about what your plan is, because you just never know where the opportunity is going to come. And that's what we're looking for, is when it's a real deal. This was a 2016 82 unit deal, and the bought it for $150 a unit. And that is really, really cheap. And so I don't discriminate on size if it's a really good deal. We did a 64 unit deal a few years ago. That I just knew, man, that was a killer deal. But typically when we do that, we're running it out of another property that's somewhat close.
Sure. You have the synergies to be able to do that.
Yeah, we're not going to go off to some side market and do 100 units, but I will not discriminate against a small size deal if it will produce the returns that we're talking about or above. Typically those, I think, are going to be bigger returns.
Okay. So you mentioned kind of loan assumptions, something that you're not crazy about. Is there anything that you're not crazy about?
Yeah. So every one of them that comes to us, so somebody will go put fixed rate debt on it. And if they did that 5 years ago, your interest rate is in the upper 4s. They take all of the IO and they get ready to sell it at year 5, which is about the last year that you can get, you can resize the loan. So there's no IO to help you. There's, they just don't work. As a general rule, they don't work unless there's something in the asset that's been so mismanaged that you feel like you can get $200 to $300 extra lift out of the unit. And I think that's what we feel like is the case for the 82 unit deal. There's one in Dallas that I have tried every which way to figure out how to make it work. And because I know whenever it's free and clear, you can sell it, it's going to go, it would absolutely be 160 a unit type of deal to north of probably 210. And that's a great game, but it's got zero cash flow on it. And I just don't have limited partners that want no cash flow.
Sure. No, it's a tough sale. So outside of loan assumptions, anything else that is kind of dead on arrival for you?
I'm sure there are some markets that I go, yeah, we're not going to go into that. Uh, there's a lot of intuition for 20, from going from 1996 to today, particularly in Houston and Dallas, there's a lot of intuition. And I know that's not helping a lot of people on the podcast who are getting into business. But I think the message out of it is be open. And you've got to get into your market. I mean, okay, so somebody brings you an asset and I can look at certain things that other people can't, but if you're starting out, you got to take that asset and go figure out where does it sit in that pocket in relationship to its comps. And that can be a C location, a B, A, it does not matter. That fundamental has not changed for us. And so there'll be places I go, I know basis now on a lot of assets. So I can go, somebody will call me on something. They'll go, it's 115 a unit. And I go, in that pocket, it ought to be 100. Are you kidding me?
Sure.
I don't say that. I politely say, thank you for letting us look at it, but no,
Sure.
that will not be a Madera deal.
Got it. No, that's helpful. And then in terms of the acquisition process for you all, how do you source your deals?
Tell you that, I'll have to kill you.
It's just between me and you and all the listeners.
This is just between me and you. So I would say I don't think of those five that we're doing this year, or we did this year. I think they were all off market.
Okay.
And so I think down the road, we'll have a conversation about things I've learned in the business. One of them is going to be relationships. It takes a long time to build those relationships. And that's a key driver for us being able to do what we do. I have underwritten, absolutely marketed deals this year. One of them is coming into January that we competed, that we went in best and final for. So most of ours will be off market.
Do you source deals directly in terms of direct owner?
No, I never go around the brokers.
Okay.
And I think there is a theology out there, and I get calls every week and they don't get to me. So now they go to my wife and how they got her cell phone number I think some of them even gotten her email. And I just said, well, babe, just go cut a deal. I mean, if they're calling you, go cut a deal. And, but they're trying to get directly to me to do the deal. And one thing that Madera will never do, the brokerage community knows, if somebody helps us get into a deal, they know they're going to get it back when it's time to sell. And, a story on that, had a broker. And so again, the deal that we were talking about that was 115 a unit in Houston and in the north side of town. I go, no. And actually I was I was a little chippy on that one to go, you got to be out of your mind to think that is 115 a door. Well, that brokerage group had sold the owner that's what they could get. So I told another broker, I said, I just got to ask about this property over here and at 115 a door. And he goes, well, that's funny because I'm the guy who got them into the property. I didn't think I was going to have to go back through the BOV fight to get the deal. And this other group gave them some obscene number and they didn't sell it for that. And I told him, I said, well, that's the reason you want to do business with Madera exclusively, because if it's coming through you to us, then when we get ready to sell it, it will be going back through you. So there's very, very little direct. There are a couple of people in the business that There's been times that I want to sell for a particular reason, and I can come to an agreement with somebody that I know, and we strike a deal, but there's a reason for me doing that, and I feel like I'm getting fair market value, but I'm still including the broker. I'm not excluding the brokers. The broker is still getting his piece.
No, that's very honorable. And then as I was kind of researching for our call, I had Googled around in terms of just other people that have interviewed you. And one of the articles that I saw talked about your business plan for your acquisitions. And it said, Charlie uses a simple cookie cutter value add business plan that involves buying 1980s properties, spending $10,000 a unit on renovations, repositioning the property to a stronger demographic group, and raising rents about $150 a unit per month. Is that still the same, or how has that evolved over time?
I'd say that was probably true from 08 up through, I don't know, not too long ago. I mean, we were buying 80s vintage assets from 08 up through, still today. But, and for the most part, I felt like it took about 10 a door to make right the deferred issues and make it competitive with whatever was in the market we're buying something because the rents are below the market, and there's a reason for that. So what does it take capital wise to make that where you can get that $150 to $200 of lift? And so that was correct. Now there is an evolution. And so, when COVID hit, I'd been telling our limited partners for a couple of years, I said, we are deep, deep into the cycle. And actually the properties that I underwrote last year, I said, are going to have a 7-year horizon on them. And the return's going to be a little less. And I told them, I said, we're going to have a recession somewhere. Don't know where that's going to happen. And I vividly remember in 09, I was at a conference in Vegas. And, everybody was sitting there. The keynote speaker was Ron Terwilliger, who is an icon and a legend in our business. He had developed over 250,000 units. And so everybody was waiting for the guru to tell them what's going to happen. And Ron had been through 3 cycles. I believe it was 3 cycles. And he said, every one of them came in a different way. Well, one of the guys says, one of the participants said, whenever you see a recession coming, do you pull back on your development? He says, you never, ever see a recession coming. Been through 3 of them. They've come in 3 different ways. And so prior to this scenario, I'm telling our limited partners, we're going to have a downturn. I don't know when it's coming, and I don't know how it's coming. And I don't think there's anybody in their right mind who would have thought in March what happened was going to happen, but it happened. And so prior to that, I was telling our limiteds, we're going to have to go on 7 years, because if we bought something in 2019, I want 7 years, because we're going to have a recession somewhere in the next few years. And that's probably going to shut things down for a couple of years. And we got to be able to be structured to ride through that. So there we are in that scenario. And so we now have a reset, and it's time to start buying again.
So do you feel, is an interesting point you brought up in terms of where we were in the cycle. And it seems that almost in a way COVID never happened, because the lowering of interest rates has kind of offset the impacts of collections and delinquency and so forth. So what is your view for, DFW and Houston assets and the runway ahead?
I would tell everybody, buy whatever they can in 2021. In 2 years, you will think that is cheap. I'm going to couch that and go, okay, you got to know that you're getting good basis for the day, but there are fundamentals that are about to hit this market. Okay. It's Friday. It hasn't happened yet, but this could be the 3rd week in a row that Texas gets news of a new HQ that's moving to town. Last week it was Oracle going to Austin. The week before that was Hewlett Packard moving out of San Jose, going to Springwood, to Houston, right across the street from the deal we bought in September.
Nice.
I look like a genius there.
Yeah, absolutely.
But there's fundamentals that began pre-COVID that I think are going to be accelerated post-COVID, and that is a number of businesses, corporations and businesses, not just out of California, but there's other places that have just not been friendly to work, and they're trying to find a stable environment that is affordable for their people, and that's going to be that's one of the factors that's going to happen. Another factor that's happening right now, I have a number of friends that are institutional players. And so what are you guys doing right now? Nothing. They can't buy right now as a general rule, but they are raising hordes of cash. Talked to one a couple of weeks ago and with Goldman Sachs. And he said, we just raised a small fund. I said, what's a small fund? He said, 3.2 billion. And it's going to be for core and core plus, aimed exclusively at the Sun Belt. And so in the next couple of years, there's going to be so much growth of population and jobs in the Sun Belt. And everybody realizes that's where your money's going to flow. As far as multifamily is concerned, and industrial and single family home sales and single family rentals. And so that's going to put a lot of pressure on our market I don't think cap rates are going up. I'm not going to budget cap rate compression, but I don't believe cap rates are going up. And interest rates, I think, are going to stay pretty much where they're at. They'll go up a little bit, but there's just so much pressure for them to stay down that I think those will stay down. And then you got a lot of people buying, and that's buying at all levels from C, B, A.
No, that's really helpful. So in terms of, your cap rate view, I mean, where do you think cap rates can go in, let's say for 80s vintage and DFW?
Well, the cap rates that we're selling on right now we just got through selling 5 assets that CB marketed for us, and the cap rates were post-COVID lower than they were pre-COVID. Yeah. And so I do some mentoring with some new folks that are in the business, and we'll talk about their reversion cap rates, and in a lot of ways they are trying to be safe and protect themselves, and I appreciate that. And they'll go, we sold a deal, and they go, they put it on a 5.5 cap, and I told them, I said, there's no way in heck that's going to sell on a 5.5 cap in 5 years. Mm-hmm. And I had one gentleman that I was working with, and I told him he was trying to underwrite one of our deals, and he put the cap rate, it was at 5.5 or higher. And I told him, I said, there's no way. I said, I'll make you a bet right now. I will take you and your wife anywhere in the world in 5 years when you sell this deal, for dinner, if it sells at 5.5 or higher. But I said, consequently, on the other side, you'll be taking me and my wife to Italy for dinner if it sells lower than a 5.5. He did not do the deal, and he couldn't wrap his head around, this whole cap rate deal. So cap rates go up. So you'll hear people say a lot of times that they're going to go to a secondary market or a tertiary market where the cap rates are higher, and they can get something less per pound. And there's a reason for that cap rate being higher. And I think you got to be very careful for that. If you're going to go into one of those markets, let's say Texas, for example, you're going to go into Longview or Tyler, and you're going to pay a higher cap rate. It really needs to be for something that you view as a very long-term hold, and you're not looking to try to get out. So we're sponsors, and our people will give us money, and they want to be able to, in 5 years, 4 to 5 years, they want to be able to harvest that. So I've got to be in markets that I know are going to be growth markets. And if they're growth markets, then you're not going to see cap rates just monumentally go up.
What, with all the money being pumped into the system through the stimulus plans and so forth, and asset prices going up, and we have stock markets at all-time highs, Bitcoin all-time highs, do you see any inflationary pressures that could cause interest rates to rise and hence cap rates to go up?
No, I think we are in such a deflationary scenario right now, and technology has been the genesis for that. That has been the disruptor that is really changing the game. And so, you got Amazon, who's disrupted the world, and everybody's got to cut their prices to be able to compete with that. Now the combustion car makers are now having to compete with Elon Musk. I mean, there's just so many forces at play for deflation as opposed to seeing a lot of inflation. I don't think that we're going to see a lot of inflation. And neither does the Fed. That's the reason they're propping it down. They're probably more afraid of prices going down. The only thing that's going up right now in just mass is home sales. Prices on homes are going up, and prices on multifamily and industrial and data centers. Hotels are dropping and retail is dropping. And so I don't see a big boogie out there for inflation.
Okay. And then, just to finish up on cap rates, I mean, how do you typically underwrite your deals, in terms of cap rate expansion or keeping cap rates flat?
All right. So we're doing a 620 unit deal in Houston, Texas, in a core location that I went to the brokerage group and I said, give me the 2 years of historical cap of sales and what the cap rates were. And they ranged from, 4.5 down into the 3s. And so we're buying this deal on, I think, about a 3.36. It's a core plus asset in a core location. And we're getting it at an unbelievable basis for a reason, which means your cap rate's going to be unbelievably low, but the upside is huge. And for that, I go, okay, I put an exit of 4.25. And then I had some people that would ask me, they go, how do you justify that? And I'm kind of back to, I don't believe it's going to be a 4.25 in 5 years. It'll be a 4 or less. And it depends on the asset as well. So this is one that it's their 09. One piece of it's 09. The other one is 2011. And in 5 years, those will be just about, they'll be 20 years old. And so somebody like NightVest could look at that and go, wow, that's a value add on the interior units. And if somebody viewed it that way, then they're going to pay down because they know that there's $300 or better of lift from value adding the unit. So every deal's different and every pocket's different. And so if you're a new person, you just need to get the last couple of years of history on that as best you can, and then go be a little conservative, but don't be putting, some people will put 1% of increase on their reversion cap rate And that's just their programmatic deal. That's just a
Sure.
program for them. And I think
Sure.
that's wrong. I think you got to look at the asset and the location and go, really, where could that be in
Where could it
5
go?
years? Some people will do 50 bits.
Sure.
And that's just their programmatic deal. The deal that we did in DFW in October, I think I put a 4 cap on that. I may have put a 4 1/4, but I had a lot of people go, how do you justify that? And I just go, that is a really, really good location that's not going to do anything but get better. And there's going to be a lot of pressure in that area. And so I think that's going to keep cap rates down. Plus, the institutional guys are going to be back. We would never have been able to buy that deal if institutions could buy today, but they can't, or at that particular time they can't. So when they come back, they're going to put a lot of pressure on cap rates.
Charlie, why have the institutions been on the sidelines?
Because they have to have absolutes. They can't be in a market that's going sideways. They have teachers' pensions. They have sovereign wealth money. They have a lot of big groups that are investing, and they have to have what they think is an absolute. We know the market's going to do 3% at this point going forward, and they have to answer to somebody. And
Sure.
So the deal that we're buying in Houston right now is a fire sale deal because the institutional seller is having to raise cash because they didn't do what they wanted to on this one fund they have, and their institutional investors are asking for their money back. And so they can sell stuff right now, and they can do write downs or take losses, but they can't buy. And so in DFW, probably within the year, you'll see them back in a big way because it's going to stabilize a lot quicker than Houston does. But it'll probably take a couple of years for them to get back into Houston. Although one of the guys I was visiting with, when we were having lunch, he goes, I'm writing a white paper right now to send up to my higher ups on why he believes Houston is an opportunistic contrarian play. But the optics of that for those guys is really hard to get around. I had one limited partner yesterday he was like, I need to catch up with you on cap rates. I just don't understand this cap rate compression, and prices have gotten high. Well, that's what growth does. That's what inflation, and there'll be certain places you have inflation and certain places that you don't. If one of my mentors, broker mentors from 2010 going forward was Dirk Goris.
Okay.
And Dirk passed away about a year ago. But Dirk told me from the beginning, he says, Charlie, inflation cures bad buys. Now I'm doing my best not to have a bad buy, but if you're in a growth market, well, that's what's going to happen. Prices are going to go up, and they're going to go up because if you take Houston, Texas, so in 1989, the average apartment rent was, I think it was about $325 in 89. Okay. 32 years later, the average apartment rent is a little north of $1,000. That's more than 3% average growth on an annualized basis. It doesn't work that way, but it's a growth market. And DFW is a growth market. In Phoenix, Denver, Salt Lake City, Nashville, running across the Sun Belt here, the Carolinas, Charlotte, Raleigh, Durham, Atlanta, Jacksonville, Orlando are all growth markets for the reasons of people moving. It was happening pre-COVID just to try to get some advantages of on their tax situations. And now that's just been accelerated with COVID.
And so, we talked about cap rates. Another big driver of valuation is rent growth, and you were touching upon it right there. What do you model in DFW, and how does that differ versus Houston for, let's say, the next 5 years?
Yeah, it's very different. So right now, the deal that we did in October, I think I put 3% rent growth across the 5 years. And it's not going to be exactly like that. It's not going to be linear like that. But I think where we're at right now in this cycle, I think that's what's going to happen. And in some areas, it'll be higher. And so somebody buying has to know some of the history and some of the future pressures that are going to come that will make that happen. And so, yeah, Houston right now, the deals that we did, the one deal that we did in September, I put no rent growth in the first year. And then I put, I think I put 3% or 2% in the second year. And then I think I went 3, 4, 4. Who knows? Who knows?
Sure,
okay.
Sure.
But what happens in Houston, Texas is Houston has bigger ups and bigger downs. And so right now you have this year, if you believe what's in the data, they opened the doors on 24,000 units. That's putting a huge amount of pressure on new construction. We've got other assets in Houston that are 96% occupied in areas that don't have construction, that rents are growing.
Sure.
Next year, they're going to have 7,000 units that the doors are going to open. And then there's one source that says only one property is going to open up in 2022. That will be that. If that
be awesome.
if that really is reality, well, then that's going to put that's the lowest volume of supply to hit the market in that 32-year period.
Yeah, that's interesting. Yeah.
And so you go back to 2009 and you have the collapse just like we do now. Okay. So Houston lost 300,000 jobs through COVID. They've gained back 100 and some odd. So they're going to be down for the year, I think 150,000. In 2009, Houston was down 110,000 jobs. In 2010, they were net 50,000 jobs, and they put 7,000 units on the market. And so in 2009, the rent growth was negative 2%. In 2010, it goes up a little bit. It gets up to about 2%. Okay. Then in 2011, they had less units that came on. It's very reminiscent of what we've got right now, but I think it was about 5,000 units. Wow. But they added 80,000 jobs. Okay. And all of a sudden rent went to 4 or 5%. Then, and I see where I'm at 2010, 11. So 2012, 13 and 14 jobs every year were above 100,000. And supply had not caught back up, and the average rent growth was 8%.
Wow.
And so that's a little bit of what we're about to experience in Houston. And it's not as violent and as radical in DFW. So you need to underwrite, kind of average, and you will probably end up above that. And it maybe in your first year, you're below it, but I feel at the end of 5 years, I'm going to be on the money or above.
Yeah, no, that's really insightful. Appreciate those data points. History does repeat itself in markets. So.
Yep.
And then if we shift gears to property management, why did you all decide to self-manage?
Well, we were managing anyway. And so we were managing for our own stuff. We had whittled down most of our third-party fee management. I think in the next year, you're going to see us provide some opportunities for some fee management again. And that's because we think there's a void in the market for that. And I think it also makes us sharp. When you're running your stuff, honestly, you can't run your properties any different than you run somebody else's. You can't run two separate scenarios of management. And so having somebody else, another owner, ask questions, I think makes you sharper. And we think there's an opportunity there. So I think you'll see us selectively do some third-party fee management starting in 2021.
Okay. And what types of assets would you manage? Going back to kind of your earlier point in the conversation of you have to be careful what you fee manage. You have to buy the right basis.
So what we're going to do is it's going to be a bit of an interview process with somebody that wants us to manage for them. I've told a number of people this story that back in 04, 05, whatever it was, when we were building up a lot of management, I had one owner that I said, all right, what's your investment plan? In my mind, I'm trying to think through how to help him achieve his goal. And he looked at me and he goes, that's none of your business. And there are a lot of people that are buying, that are in the business, that's their mindset. They don't want their fee management company knowing what their plan is because they might move their people. Well, we're not going to do that. If somebody wants Madera to manage for them, then we're going to be very candid and transparent about where you're at and what you want to do. And actually, we're going to look at your underwriting and go, are you realistic or not?
Sure.
Because if you're not realistic, we're not going to take on the asset, because at the end of the day, we're the ones that get looked at as the owner. And if they're not paying their bills, then we get looked at as the bad person. So we think we can do it a little different. And that would be with people that want to be collaborative and not view your management company as a commodity. Your management company needs to be viewed as a tool. And if it's not, then they won't be working with us.
Interesting. And so, one of the things that you highlight on your website is technology. So maybe just touch upon the technology that you all use on the property management side to run assets more efficiently.
Yes. So we have, the last 2 years, created a technology company called Quext. And it started out with just with Wi-Fi and video feed or cable. And so we deployed that across all of our assets in DFW, and now we're moving that across Houston. And that provides us, if a resident moves in, they move in and they plug and play for Wi-Fi and video. It's also a revenue source for the property. But during COVID, when all these people had kids at home that were homeschooling, we looked like geniuses because we had the Wi-Fi. They showed up and they got it. That's number one. The second piece is going to be IoT. IoT is for those, that's the Internet of Things. And in your homes, most people's homes these days have all the different smart technology, whether it's their thermostats, whatever. Everything is moving to the Internet of Things. And so our apartments are going to have a base that's going to start with thermostats and locks. And then whatever other Internet of technology that arrives, will be able to pivot and work off of that in a unit so that an apartment can function very much like just like a regular home.
Okay.
And we think that's huge. So if anybody's looking for that, they could go to onequext.com. And
how do you spell Quext?
ONEQUEXT.com.
Okay, Quest. Sorry. That sounds great. Yeah.
Quext.
Okay.
And we're going to start making that available to other operators.
Oh, that's interesting. And is that available to other operators that have, different fee managers, or just to those that are okay?
Yeah, absolutely.
Okay. And so, typically what does the Wi-Fi and video feed cost a resident? And I assume it's just billed monthly as part of above their rent.
Yep. So we'll take Dallas. If the big provider for video and Wi-Fi and video is Spectrum.
Okay.
Or Charter Communications. And so if you go on the street with those guys, you're going to pay about $150 for the complete package. Our residents pay $90. And if you buy it on the street, the odds are you're going to get 75 megabits of speed up and down, which is fine unless everybody in the unit is using Wi-Fi at the same time. And our units have 300 megabits of speed. So they get more speed and options at a cheaper price, and they don't have to go sign up for it. They just show up and it's there. But everybody pays for it.
And you're doing that in Houston as well, Charlie?
Mm-hmm. Yep.
Okay. And then one thing that I wanted to touch upon was the faith-based aspect of your business. Maybe you can just talk about that and how that impacts how you run your business, how you run your properties.
Yeah, I think whenever we started with that, the way that we wanted to approach that is be transparent. And I think the key part of it is just being authentic in who you are, what your values are, and what the base is. And so everybody knows that. And that's kind of the core of it. We have people of different faiths. We have people of that do not have a faith that work for us, and we've got equity that is that would be Jewish, and and we've gotten to such a point where everybody's like, it's got to be my way, and I just think that is absolutely wrong. And so we're not out to change anybody, but they know where we're at. They know what our core is, and so I think the golden rule is do unto others as you have them do unto you. And so that's kind of where that goes. And that's pretty much what that means.
That's great. That's great. So early in the conversation, you talked about a gentleman that heads up your, CapEx. So maybe you can just talk about what you do in-house in terms of CapEx and unit turns versus what you outsource.
For us, there's an awful lot of it that's outsourced because we'll go through periods of we won't have a whole lot to do, and then all of a sudden we'll get overrun. And you can't, for us, we haven't been good at ramping up or ramping down. And so we have some sources that we use that are outsourced. So pretty much the majority of it is outsourced with our oversight, providing the leadership for it.
Okay, and that's on unit turns as well?
That's for unit turns.
Okay.
Your exterior construction is all outsourced. Pretty much for us, I would say, I'm sure I'm missing something and I'm overstating it, but, like we're buying 800 plus units that we're going to buy, one of them in January and one of them in March. And they are pure value adds. They are big time unit upgrades. And so for us, we just can't keep a staff sitting around ready to go on that, but we can go to some partners and pull off of them.
Okay. And Charlie, just to make clear, on the unit turns, you also outsource those as well? Mm-hmm. So the maintenance team doesn't help. Okay.
They come in and do the final touch up.
Okay.
And they probably install the appliances, but cabinet turns and flooring and light fixture. They do the fixtures, the light fixture installs. But the big bulk of it is contracted out.
It's contracted out. No, that's helpful. Well, great. As we kind of pivot to the end of the show here, I just wanted to go into just some advice that you have for people getting into the business, both passive investors and first-time syndicators.
Okay, so if it's passive, you do your research on your operator, and there are some really good operators out there. And I don't know that I have a magic I've not been looking for the operators. So, I mean, we're available. But I mean, real estate's such a great vehicle. I mean, outside of finding some great technology that you get in on the low end of it and ride it up, it's one of the best vehicles out there for the tax advantages and the consistency that can come with it. So find a good operator and tag into them if you're looking for passively investing. If you're a sponsor and you're getting started, I can vividly remember, I can just go back to those days. It started in 2008, and when we said, okay, and we had a chance passing with some people that we knew, and they were like, man, we need to put some money out. And that was the time that we said we're going to go out and do our own deal. And so that was our seed money at the time. It was eight individuals. They are all, except for one of them who just got so old, he said, I can't invest anymore, but the rest of them invest in every project that we do. And so it's a momentum deal, and it's a deal of doing the right thing. If you do the right thing, then it just builds. I remember talking to a mortgage broker back in that period of 2008 and looking at, so our first raise was $2.5 million. And I thought that was all the money in the world and for raising. And we got that done. And the next one was $3 million. And, and the base just kind of kept growing. And so I think we're at about 100 deals now that we've bought. I think the website's a little old. I think we're at 100. We've gone full circle on, I want to say 40 deals now or north of that. And we're batting 1,000 on, we said we were going to do this and we exceed this.
That's awesome.
So my philosophy has always been under promise, over deliver. Mm-hmm. And so I do my best to conservatively hit that. I'm sure somewhere we will have something that does not work the way that we want it to, but the investor comes first. Always the investor comes first. A lot of people get into looking at the fees that they can get. And if you're doing your job and they're getting what they are expected, then that's fine. You take your fees, but you don't take your fees ahead of the investor getting whatever you told them that they're going to get. And so we started out with that one deal at $2.5 million of raise. Our average deal right now is probably $20 million. And that eight investors has grown to somewhere north of 300. And the deal that we're working on in Houston right now is a $45 million raise. Wow. So it's just a momentum deal of doing the right thing. I tell people, think 10 times, and it's okay. And it's not thinking 10 times to just go, oh, I want to be that big. You're thinking about your capabilities and how to expand your capabilities so that when an opportunity comes, you can take advantage of it. And so, this year we bought the 82 unit deal was $12 million. The deal in Garland for 148 units was, I think it was 13 million, something like that. And then we bought a deal for 40 million, and then we bought the deal in Dallas in October that was right at 60 million. And so it's just, my point is, think 10 times so that you can develop your capabilities and your skill set so that you can take advantage of the opportunity that comes before you. And so now we're working on this deal in Houston that came up. It's 123 million, and we're raising 45 million. And we're going to get there, but it's a stretch. You can't be comfortable. You can't be comfortable in this business. And that's not saying that we're going to go try to do some big portfolio, although we did dabble with one of those one time. It's just, building your skills, doing the right thing, continue to give good returns to your investors, putting your investors first. We sold 2 deals last week, and the investors got their notices yesterday, and it's
happy days.
It's an awful lot of fun to get the emails. This is the difference between being a sponsor is really good, because you have limited partners who really appreciate what you're doing. And so, here's a guy from yesterday. He says, just saw the distributions from Eagles and Stone Ridge. Feels like Christmas came early. Always. Thanks for the opportunity. What I like about being a sponsor is you get that. I can remember one guy, it was his first time to go full circle with us, and we just hit a home run. And he freaked out. He sent me a text. He says, holy crud, that's awesome. My house in Beaver Creek's available. My plane's available anytime you need it. You just let me know. And that is very rewarding. You don't get that whenever you do a fund and you're doing institutional work, because it's just a number to them.
Sure, it is. That's right.
So Madera is going to stay in the world of being a sponsor. We'll probably be a really, really big sponsor.
Interesting.
And that game will evolve. But I like making money for other people, and I like what I do, and I like helping them out. So that's my thoughts on that topic.
That's awesome. If you'd see my notebook here, there's numbers of a lot of notes on a lot of pages. So really appreciate your time, Charlie. This was fantastic. And just a few quick questions. You had mentioned some deals that you have in the market. What are the minimums for the investors?
Right now, 100,000. Well, what we do is it's 100,000, and our investors are, you go through who's been loyal to you from the beginning, and you start with those folks. If we get down to the end and we need to, and we've invited everybody has responded for whatever they want, then you could see us go to 50,000. But it's a general rule. It's 100,000, and it's all over the map. I mean,
sure.
We got guys that'll put 3 million and down to 100,000.
Sure.
And so I have to craft my plan around getting the whales and guys in between, and you just keep going down.
Awesome. How can listeners get in touch with you?
So Charlie at MaderaResidential.com. I would say if anybody's listening to this, make reference to the podcast, because there could be a chance that I missed the email. When the emails start on Monday, they just come blowing through. And if I don't,
Sure.
or a lot of times I just, or I don't know the reference to them, then I just delete them. And sometimes somebody will not get a response from me, and they go, hey, they'll send me another one, and I'll finally catch on. I do my best be able to respond to folks that are looking for something as it relates to this.
Great. No, well, thank you, Charlie, so much for your time. This was incredible. I think the listeners will also be taking notes and with all the wisdom that you shared and from all your experiences.
Happy to be a part of it. Thanks for reaching out and putting me on your Christmas wish list.
Thank you so much.
Thank you for listening to Multifamily Rockstars. We hope this episode was helpful for your personal and professional growth. For more episodes and to learn more about investing in multifamily apartments, check out lifechangingcapital.com.